tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hey folks, welcome to the Power of Zero show. I am your faithful host, David McKnight, best-selling author of The Power of Zero, Look Before You Lerp, The Volatility Shield, and releasing today, wherever you buy fine books, is Tax-Free Income for Life, a step-by-step plan for a secure retirement, as this day has been a long time coming. It was originally supposed to launch in February, but because of COVID and me being confined to my house for 4 months, I was able to finish it a lot earlier. So we are able to launch this book, about which I'm very excited if you can't tell, today, November 17th. I would encourage you to head over to Amazon or, like I said, wherever you buy fine books and order a copy. I would really appreciate it, be indebted to you. And we'll be able to tell you by this time next week whether we were able to hit bestseller status with New York Times and Wall Street Journals. Exciting times. Today is the final installment of in a three-part series where we discuss what the book is about, what you can anticipate, how this will round out your concept of Power of Zero retirement planning. You'll recall in the first two episodes, we talked about how longevity risk is something that really strikes almost every portfolio, is something that is on the mind of every American. It is in survey after survey, the number one concern on the minds of people that are retiring or are planning to retire. And people just are afraid of running out of money before they run out of life. And we talked about how there's a couple of different ways that you can mitigate that risk. You can either do the stock market way where you accumulate a huge pile of money and restrict your distributions to 3% and have a statistical likelihood that you'll never run out of money. We talked about how that's the most expensive way of going about it because you have to have a lot of money saved up by day one of retirement to be able to pull that off. And the second way we talked about is by way of an annuity that guarantees lifetime income. And we talked about how historically the way that the economists and the mathematicians tell us to do it is the most effective way is by way of what we call a single premium immediate annuity. And essentially you give an insurance company a chunk of your net worth in exchange for a stream of income that's guaranteed to last as long as you do. You will never outlive that money. You could live to 120. You will still have to find a way to keep spending that money that will keep getting automatically deposited into your checking account. We talked about, however, that there's a number of shortfalls associated with this approach, namely that people don't like losing liquidity. You give an insurance company $500,000 in exchange for that stream of income. It may have all sorts of mathematical benefits for your retirement. That's been proven in study after study. But people don't like giving up liquidity on that money. And it primarily has to do with what we call the Mack Truck Factor. The Mack Truck Factor is, hey, you may have a Methuselah gene. You may anticipate living longer than everyone else in the risk pool. But should you step off that curb 2 years into receiving that guaranteed lifetime income, get smacked by a Mack truck, then that income stops. That $500,000 is long since disappeared from your balance sheet, and your heirs have nothing to show for it. Okay. So a third issue that people have. So it's not just the liquidity, not just the Mack Truck Factor, is the inflation factor. SPIAs in their most simple forms historically do not adjust for inflation, and so you might give the insurance company $500,000 and in return they give you $30,000, but that is a fixed number. So as inflation goes up, your spending power gets reduced accordingly. Okay. And we also talked about how insurance companies have recognized that, yes, there are mathematical benefits associated. There's not just mathematical benefits. There's longevity benefits. There's health benefits. There's psychological benefits associated with having a guaranteed stream of income that lasts as long as you do. So they recognize all those benefits, but they also recognize that the primary pitfalls of the SPIA give people heartburn. And so they've they've created solutions that help mitigate those risks. And one of them comes in the form of what is known as a fixed index annuity. And a fixed index annuity basically says, look, you're not required to take that guaranteed lifetime income right away. You can actually have a deferral period. And during that deferral period, you can have liquidity on those dollars at 10% per year. So $500,000, 10% of that is $50,000. That doesn't seem like a huge amount, but when considered within the context of the 3% rule, it's like I said before, practically Mardi Gras. And the growth of the money in these accounts and these fixed index annuities is linked to the upward movement of stock market index. And that drives the growth of that guaranteed lifetime income over time. So even if you're getting, say, 3, 4, even 5% on return on those indexes, your lifetime income is increasing by that amount over time. And finally, these fixed index annuities have death benefit features. Basically, whatever growth you experience on that $500,000 example, subtract from that the income you've taken before you die, and whatever's left over goes to your beneficiaries. Everything seems pretty rosy. Everything seems like peaches and cream at this point. The problem is these annuities get implemented 99% of the time within the tax-deferred bucket, meaning you are exposing yourself sometimes in a permanent way to the impact of rising taxes. And because the income coming out of those annuities from the tax-deferred bucket counts as provisional income, you're increasing the likelihood that your Social Security will be taxed. How do we mitigate this issue? All insurance companies say, hey, you can feel free to convert that money in that fixed index annuity, that FIA, to a Roth IRA. We're happy to help you do that so long as you do it before you elect a guaranteed lifetime income. We're happy to allow you to do that. However, here's the proviso. You have to execute that you have to execute that Roth conversion all in 1 year. If you have $500,000 in that annuity, you execute that Roth conversion all in 1 year. What have you done? Well, in an attempt to avoid a doubling of taxes over time, you've really doubled your taxes in the short term, because $500,000, dump that into your tax cylinder. That's going to push you right to the highest marginal tax bracket, which is not what you're looking to do. You are looking to avoid a doubling of taxes over time, but you essentially doubled your tax rates in the short term. What we're going to talk about today is a feature that a couple of annuity companies offer. And it's what we call a piecemeal internal Roth conversion. That's actually a phrase that I've coined. Other people, companies call it a internal conversion, but I don't think that's descriptive enough. Internal conversion, what does that really mean? We're talking a piecemeal internal Roth conversion. Piecemeal simply says that you can convert that annuity to a Roth IRA over whatever time frame your financial plan calls for and whatever amounts your financial plan calls for. So instead of having to convert all that money over 1 year and realize $500,000 of taxable income all in that same year, you could say, hey, look, I want to stay in the 24% tax bracket. I want to get all the heavy lifting done before tax rates go up for good in 2026. Therefore, I want to convert that $500,000 IRA incrementally in a piecemeal fashion over that. We now have 6 years. As of January 1st, we'll have 5 years. But if we take advantage of 2020, we'd have 6 years over which to execute that Roth IRA or that Roth conversion. What that allows you to do is it allows you to stay in a much lower tax bracket over the arc of that Roth conversion. So essentially, you have all of the benefits of which we've spoken so far of having guaranteed lifetime income, but now you're effectively able to eliminate what I think are still the two greatest risks to your retirement. You are able to eliminate tax rate risk, and kissing cousins with tax rate risk is Social Security taxation, because they all should be considered within the same. By the way, Social Security taxation, as tax rates go up, you get to keep less of your Social Security. So tax rate risk, we're able to mitigate tax rate risk simply because we have accumulated, we were able to reposition the money from tax deferred to tax free, and then we choose to elect that guaranteed stream of income adjusted for inflation, but now it's tax-free. It's coming out of our tax-free bucket, does not count as provisional income, does not count against the thresholds which cause Social Security taxation. And because it's a guaranteed stream of income, we have also completely removed longevity risk from the table. And remember, when you eliminate longevity risk, what do you also eliminate? You also eliminate all of those other sub-risks that can threaten to derail your retirement plan. What are we talking about? We're talking about sequence of return risk. We're talking about withdrawal rate risk. We're talking about inflation risk, so on and so forth. So in long-term care risk really is a risk that we mitigate with the LIRP, but those first three risks can be completely taken off the table thanks to guaranteed lifetime income. And if we can reposition those dollars over 5 or 6 years into tax-free, by way of the piecemeal internal Roth conversion, then we have effectively mitigated both longevity risk and tax rate risk within the very same financial plan. Historically, what happens is financial advisors will say, hey, look, I can only mitigate one of these risks. You got to pick which risk you want to mitigate. For example, if you want to do a bunch of Roth conversions, then that means we have to keep this money liquid. Therefore, we cannot put any money into an annuity. So that means that you're stuck. You can mitigate tax rate risk, but you can't mitigate longevity risk. Conversely, people say, hey, look, we can mitigate longevity risk, but the minute we put it into the annuity, we're going to lose liquidity, the liquidity that's required to be able to do Roth conversions. So it's always been this fork in the road, this bifurcation, if you will. You have to focus either on mitigating longevity risk or mitigating tax rate risk. What the plan that I outline in tax-free income for life is a plan that allows you to fully and effectively remove longevity risk, along with all of the risks that get magnified as a result of longevity risk, and tax rate risk within the very same financial plan. This is exciting stuff, folks. This is groundbreaking stuff, and I'm excited for you to learn about it in tax-free income for life. I would love nothing more than if you could buy, and really, I'm asking you to buy the hard copy. We're trying to make this thing a bestseller. Buy the hard copy. The Kindle or the Audible doesn't really help us, believe it or not. Those have all of their bestseller lists. We're trying to aggregate all of our purchases under the hardback. So please buy the hardback. Buy it under your account. Buy it under your spouse's account. Buy it under your kid's account. All of those count as separate purchases. And like I said, I will update you next week on the results of, hopefully we know by next week, the results of the bestseller status. If you are looking for someone to help you navigate all the pitfalls that stand between you and the 0% tax bracket and help you mitigate both longevity risk and tax rate risk within the very same financial plan, head over to davidmcknight.com, click on strategy session, and we will hook you up with a elite POZ advisor, one who is a member of our elite POZ advisor group in your neck of the woods. So you can talk with them either by Zoom or in person. If you feel like that is, if you are concerned about health, you can do it over Zoom. If you're not as concerned, they will certainly social distance within their office to make sure that everybody's safe. And if you're an advisor who wants to learn how to do this for your clients, please head over to powerofzero.com and we'd be happy to chat with you about that. Again, today is the official launch day for tax-free income for life. I would love if you put a review on there. Reviews, believe it or not, help a whole lot. And for that matter, if you want to do reviews for any of our other books as well, I would be absolutely tickled pink and honored, frankly. Thank you, folks, for listening today, and thank you for purchasing my book. I hope you find a lot of value in it. I hope you feel like that Power of Zero and Tax-Free Income for Life, they're really companion volumes. I think that Power of Zero sets the case for why we need to mitigate tax rate risk. And then, of course, Tax-Free Income for Life talks about longevity risk and how do we mitigate both of those risks within the same financial plan. I will look forward to chatting with you next week. Next week, we will talk a little bit about the impact of the Joe Biden election, what you can expect moving forward. And I've got some very insightful thoughts on that. And hope everybody has a great week. Talk to you same time next week.